Welcome back, everyone. Let's just jump right in, shall we? Today, we're diving deep into the financial backbone of a massive global powerhouse. In this explainer, we are going to completely master the record-to-report process, what we call R2R. We're going to track the exact path of a financial transaction through the accounting cycle, looking specifically at how it's handled at a company like Accenture. So if you've ever wondered how these massive corporations take a mountain of chaotic daily operational data and turn it into crystal clear financial intelligence, well, you are absolutely in the right place.
Okay, so here is our roadmap for this explainer. We'll start by meeting the R2R analyst. Then we'll cover recording and posting, hit our first checkpoint at the unadjusted trial balance, and move right into making crucial adjustments. Finally, we'll finalize the financial statements and wrap it all up with the month-end close. Section 1. Meet the R2R analyst, the guardian of balance sheet integrity. Before we talk about the people, let's define the actual arena. Record-to-report is the critical finance mechanism that collects, processes, and ultimately delivers accurate financial data. Think of it as the ultimate translation system. It takes raw, everyday operational events, say a massive vendor purchase or the depreciation of a delivery fleet, and structures all of that to provide a totally clear, accurate picture of a company's financial performance. It's literally the bedrock of financial transparency.
And right at the center of this massive translation machine is the R2R Ops Analyst. Now, at a firm like Accenture, this role is incredibly high stakes. The analyst is the one actually posting those journal entries, preparing complex balance sheet reconciliations, and executing strict internal controls. They're also the ones supporting vital audit processes. Ultimately, they're the drivers during the month-end close, making sure everything complies with global standards. They aren't just crunching numbers, they're literally safeguarding the truth of the business.
Let's move on to Section 2, recording and posting transactions, where the journey begins.
So, the very first step of the accounting cycle is capturing these daily business transactions in the general ledger. And analysts deal heavily with two main types of journal entries here. First up, you have ad hoc journals. These are your one-offs, processed strictly as needed, like, say, recording the sudden, unexpected sale of a specific fixed asset. Then, on the other hand, you have recurring journals. These happen like absolute clockwork every single month, like booking standard accruals or running regular depreciation on your machinery. Now, what's really interesting here is bridging the pure theory of accounting with the practical reality of modern finance. At Accenture, analysts practically live inside ERP systems like SAP, and their daily toolkit involves very specific transaction codes. For example, they use FP50 to enter general journal postings. But wait, what happens if they make a mistake? Because you can't just hit delete on a posted entry in SAP. Instead, they use FB08 to reverse the document and correct the error. And to actually display and review those general ledger line items, they rely heavily on FBL3N.
Section 3, the unadjusted trial balance, the first checkpoint.
Okay, so after all those initial transactions are recorded and posted to the ledger accounts, the analyst prepares the unadjusted trial balance. And right here, they hit a wall. They face the most fundamental accounting question imaginable. Do your total debits equal your total credits? This is the mandatory checkpoint, guys. If the answer is no, you literally do not pass go. The ledger accounts absolutely must summarize properly before you can even think about making further refinements to the books. At this specific stage, ensuring accuracy is just paramount, and a major tool used here is the Bank Reconciliation Statement, or the BRS. Basically, this process matches the company's internal ledger balances with the actual external bank statements. If there's a discrepancy, say a payment cleared the bank but for some reason isn't showing up in the ledger, the analyst has to resolve it by clearing open items. In SAP, this is executed using codes like FF67 for manual entries or FF5A for uploading the statements directly. It ensures your internal books actually reflect the real-world bank reality.
Moving right along to Section 4, making crucial adjustment entries, refining the books. You see, that unadjusted trial balance we just talked about, it's really just a rough draft. Now analysts have to post adjustments to make sure the correct period's income and expenses are reflected accurately. A huge part of this is accruals. This just means recording expenses incurred but not yet paid, or income earned but not yet received. Let's make this real for a second. Imagine a company has an outstanding loan. They definitely owe interest for this current month, but the actual cash payment isn't due until next month. To be perfectly accurate, the analyst must accrue that expense right now, today, in the current month's books. usually using a transaction code like FB50.
Then we have another critical adjustment, which involves spreading out the cost of massive purchases over time. This is where we contrast depreciation and amortization. Depreciation is simply the allocation of a tangible, physical asset's cost, like a massive bottling machine or a delivery truck, over its useful life. In SAP, this is calculated using the AFAB transaction. Amortization is the exact same underlying concept, but it's applied strictly to intangible assets. We're talking patents, copyrights, or wildly expensive enterprise software systems.
To really grasp depreciation, it helps to look at the fixed asset lifecycle. It's almost like a mini story for every big purchase a company makes. Step 1 is acquisition. You buy the asset and set it up in the ledger. Step 2 is in-service. This is where the asset actually starts working and you begin those monthly SAP depreciation runs. Step 3 is managing costs. So a routine oil change is an immediate expense, but a total engine overhaul, that's a capitalized improvement. And finally, Step 4 is disposal, where you sell or scrap the asset, getting it off the books entirely and recording any resulting gain or loss.
But actually, scratch that. Does every single purchase a company makes go through that whole elaborate life cycle? No way. That is exactly where the capitalization threshold comes into play. It's a very specific monetary limit set by the company. If you buy a $20 mousepad, it's immediately expensed because it's way below the threshold. But if you buy a $10,000 server rack, it crosses that line and must be capitalized as a fixed asset. This is absolutely crucial for practical efficiency. I mean, it stops the finance team from wasting valuable time depreciating office staplers over 5 years. Now, what happens if the value of an asset just tanks unexpectedly? That brings us to an impairment loss. Let me share a quick story from the source material to illustrate this. Imagine a company owns a highly specialized manufacturing machine with a net book value of $150,000. Out of nowhere, brand new technology hits the market, rendering this machine completely obsolete. The analyst tests it and finds its true fair market value has plummeted to just $90,000. Well, that analyst has to immediately record a $60,000 adjustment, an impairment loss, so the books reflect the true current economic reality.
Let's look at Section 5, finalizing the financial statements, the ultimate deliverables.
So after all those critical adjustments are made, the accruals, the depreciation runs, the impairments, the analyst generates the adjusted trial balance. And this brilliantly illustrates where all that perfectly refined data goes next. It feeds directly into the ultimate output of the entire accounting cycle, the 3 critical financial statements. You've got the profit and loss account, the balance sheet, and the cash flow statement. It's pretty amazing. All that raw, daily operational data has finally been transformed into a clear, strategic picture of the company's financial position.
Internally, to help management actually make sense of this performance, the data is sliced up into profit centers and cost centers in systems like SAP. A profit center monitors units that actively generate revenue. Think of a specific, high-performing sales division. A cost center, on the other hand, strictly tracks expenses by function, like your IT or HR department. This categorization is a game changer because it helps leadership see exactly where the money is being made and exactly where it is being spent. And finally, Section 6, the month-end close, the high-stakes finale.
This is what it all builds up to, the month-end close. Let me tell you, this is a strict, incredibly fast-paced schedule where delays are literally not an option. The timeline typically dictates that analysts prioritize GL reconciliations first. Then, they have to execute the asset depreciation runs. Right after that, analysts book the final month-end accruals. And lastly, they perform intercompany eliminations, which is crucial to ensure there's absolutely no double counting between corporate subsidiaries. Flawless prioritization is the only way to survive this pressure cooker.
So, the absolute crucial point here is captured perfectly in this quote straight from the Accenture Operations job description. The record-to-report team helps clients in their operational efficiency and balance sheet integrity, cuts time to close, and safeguards compliance. This isn't just about balancing a spreadsheet at the end of the day. The R2R analyst provides immense strategic value. They ensure the entire multinational company operates on a rock-solid foundation of absolute financial truth. We've traveled all the way from a single, raw transaction right through to the finalized financial statements, completely guided by the vital work of the R2R analyst. You've seen the logic, you've seen the specific SAP tools, and you understand the crucial adjustments required. So, I leave you with this thought. Knowing the immense impact and the incredibly high stakes involved in this process, are you ready to dive deeper into SAP and master the month-end close yourself? Thanks so much for exploring the R2R accounting cycle with me in today's explainer. Catch you next time.